Hello everyone and welcome to Economics X. If you turn on the financial news right now, you are being told one simple, powerful story. The stock market cannot be stopped. We are seeing the S&P 500, the Nasdaq, and superstar stocks like Nvidia print new all-time highs. It is impossible to deny how resilient the stock market has been, especially through the summer months of 2025. This strength has defied the expectations of many analysts, including my own, who saw weakness on the horizon. And in the shadow of these massive stock market gains, we've seen continued quiet strength from gold and silver. Let's be clear. Gold and silver combined are still more valuable than everything else on this list of top investable assets, but their share of the top 10 investable assets has taken a noticeable hit. It has dropped from a 2025 high of 58% down to 53.4% today. This single data point has caused a wave of anxiety and confusion. It has people wondering if the precious metals run is over. They're asking, is it time to shift focus away from precious metals and jump back into the stock market? After all, stocks seem to be offering much higher gains, and there is talk about gold and silver topping out. But this narrative ignores a crucial, conflicting piece of data. Even with this recent pullback in share, precious metals are still significantly outperforming the S&P 500 over the last 12 months. So, in this video, I want to cut through all of that confusion. We will start by answering the most urgent question. Are gold and silver actually topping out? Once that's covered, I want to show you some very important changes to the investment landscape. I will make connections that other channels are not making to explain why you must review how your portfolio is allocated. This is especially true if you are overweight stocks and underweight on gold and silver, because that could be a huge mistake. Let's get right to the analysis. Are we at the top of the precious metals market right now? My data-driven answer is no, we are not there yet. To illustrate this, I'm not going to use opinion. I'm going to use the gold to silver ratio, also known as the GSR. This ratio is a powerful indicator that measures how many ounces of silver it takes to buy 1 ounce of gold. What I've done here, which is different from past videos, is I've added the 3-year moving average. This line measures the average GSR level over the last 3 years. It gives us a baseline, a fair value signal for the ratio. As you can see from the chart, the GSR is currently above this 3-year moving average. It's just barely above it, but this fact is significant. It means the ratio is currently higher than where it has been trading over the last 3 years. Why does this matter to you? Because historically, you do not see a major metals market top or even a significant local high until the GSR falls and corrects below that line. When a real mania phase kicks in, this ratio doesn't just dip below the average, it crashes altogether. This is exactly what we saw in the last major blow-off top back in 2011. Right now, the data is simply not showing that kind of mania. And even though silver has been making very strong moves to the upside recently, we need to look closer. When we look at the price of silver on an average basis, meaning the average price for all 365 days in a given year, we see a clear picture. The moves up for silver in 2024 and so far in 2025 are strong, being up 19% and 20% respectively. But these gains are nowhere near what we saw in the market blow-off top situation from 2009 to 2011. Back then, the average price of silver rose 39% in 2010, and then it rose a whopping 73% in 2011. Those are the signs of a market top. What we are seeing today are the signs of a steady, sustainable bull market, not a bubble. These are clear signals to me that neither gold nor silver have seen their tops yet. So, what is the mainstream media missing? They are confusing a healthy consolidation with a top. They are looking at the stock market's all-time highs and assuming that capital must be flowing out of metals and into stocks. But the data over the last 12 months proves this is a false narrative. Precious metals have provided superior returns. The recent drop from 58% to 53.4% in asset share isn't a panic. It's a reflection of the denominator, stock market valuations, expanding rapidly, driven by AI hype and a handful of tech companies like Nvidia. This isn't gold and silver losing value. It's the rest of the market becoming inflated with paper gains. This brings us to a critical juncture for every investor. If you are thinking about either entering or exiting a gold or silver position right now, the next part of this analysis is going to be extremely important. The question isn't just whether metals are topping. The question is, what is the alternative? If you sell your metals, where does that money go? Does it go into stocks at all-time highs? Does it go into cash? We are going to take a serious data-driven look at the popular alternatives to precious metals, starting with cash savings. I will start by stating the obvious. Cash, even in a high-yield savings account, isn't what it used to be. This isn't your grandfather's savings account. Because of higher, persistent rates of inflation and the laughably low interest rates available for regular bank customers, cash has become a losing proposition. This hasn't just been a recent phenomenon. This has been true in every single country around the world, basically since the early 2000s. Cash is a melting ice cube. To better illustrate this point, I've put a table together that I've shared here on the channel in the past. This chart answers a simple question. What would you have today if you had saved $200 each month since January 2000? We will compare three assets: silver, gold, and cash. And just so you know I am being fair to the cash argument, I have added a 10% premium to both gold and silver to account for dealer markups. And I am comparing that to a 5% annual return on your cash. Let's be perfectly clear, getting an average 5% return on cash since 2000 has been basically impossible for the everyday investor. But I want to make the comparison anyway, just to show you how weak the case for cash really is. What does this data show us? Your cash earning a very generous 5% per year since January 2000 would have returned you 100%. Your total investment over that time would have been $61,400. So you doubled your money over 25 years. I can guarantee you one thing. You did not beat inflation. You are poorer in real terms. Now let's compare that to silver. Silver has returned 193% on a dollar-cost average basis over that very same period. This is buying $200 worth of silver a month, even paying that 10% premium above spot price. And then we look at gold. Gold has returned nearly 300%. This data proves my point. Over the long term, cash is indeed trash. It is a tool for liquidity, not a store of value. So, if cash is a guaranteed loser, the only thing we can reasonably compare gold and silver to is the stock market. For this analysis, we're going to use the S&P 500 as our proxy, and we'll use the exact same principle. We will invest $200 a month, every month, starting in January 2000. Now, I am not even going to hide the fact that the S&P 500 has done extremely well over that period of time. I am not against owning stocks, unlike some metals-only commentators. My job is to analyze the data, and the data is clear. But it's also changing. First, let's look at the headline number. On a nominal basis, meaning just the price appreciation, the gains on the S&P 500 since January 2000 are actually lower on a dollar-cost average basis than the returns on gold. You heard me right. The S&P 500 is up 276%. Gold is up 297%. Gold, on a price-to-price basis, has beaten the stock market for 25 years. But this is where the stock advocates chime in with the single most important argument for stocks: dividends. And they are correct. Historically, dividends are the engine of wealth in the stock market. When you factor in those dividends, assuming you simply reinvest them all, the S&P 500 becomes the clear winner here. It is up almost 400% since January 2000 on a dollar-cost average basis, including dividend reinvestment. This single chart is the reason most financial advisors tell you to just buy the index and ignore metals. But this is where our analysis begins, not where it ends. For those of you who think this is a sign that the S&P 500 is the only asset you need to own, for those who believe that by owning precious metals, you are actually losing money, there is something critical you need to know. The fundamental nature of the S&P 500 has changed. The index has been taken over by major tech companies, and this takeover has had a profound and negative impact on the investor. the average dividend yield, the very thing that separated metals and stocks in that comparison I just showed you, is falling. That passive income that stocks on the S&P 500 use to generate for you is going away. Big tech companies famously reinvest their cash into growth. They don't pay it out to you. Because of that structural change, I think a fairer comparison, a more relevant comparison for your future, is to measure the performance of silver, gold, and the S&P 500 from 2020. This measures the performance after the dip in the S&P 500's dividend level. It measures the post-pandemic environment, where people have focused heavily on tech and growth stocks. And if we compare these three assets since January 2020, you can see something shocking. Even with the stock market at all-time highs, so you cannot accuse me of cherry-picking the data here. Precious metals have done extremely well. In fact, gold has outperformed the S&P 500. Let me say that again. Gold has outperformed the S&P 500, even when you include dividends, since 2020. Gold is up 52% over that period. The S&P 500, including dividends, is up 47%, which, by the way, isn't far off from silver's 44% return over the same period. This data proves that the economic operating system has changed. The old rules, that stocks always beat metals because of dividends, are no longer holding true in this new era. And looking forward to the future, on top of factoring in these falling dividends, we have to factor in coming U.S. legislation. This legislation potentially changes the entire playing field for precious metals versus the S&P 500. I'm talking about the executive order that Donald Trump is reportedly planning to sign. This order will allow 401k retirement plans to invest in cryptocurrencies, gold, and private equity. Although we haven't heard anything definitive about silver yet, it may open the door to silver as well, via a general category of metals. Now, that order has not been signed yet, but it could happen soon. And if it is passed, it will lead to billions of dollars, flowing from the $9 trillion 401k market, flowing directly into gold as investors are finally allowed to diversify their main retirement savings portfolio. This is a demand shock that has not even begun. So, let's come back to this data that stretches back to January 2000. It would be incorrect of me to say that stocks stink and that you shouldn't own any at all. I am not going to say that, but I will say this. Enough has changed over the past 6 years, with more changes on the way, that we should not expect a one-to-one continuation of this chart over the next 25 years. Because when you put all of the elements I've just talked about together, the economic equation is completely different. You have falling interest rates for cash savers. You have lower dividends for stock investors. You have the potential opening of the $9 trillion 401k market, at least in part, to precious metals. Plus, you have the central bank gold stacking trend, where nations are buying gold at a historic pace. A trend we've seen really accelerate since 2022. When you combine all these factors, I'd say being underweight on gold and silver, so not having enough of it, is a bigger risk today than not owning any stocks at all. I encourage each and every one of you watching this video to look at your investment portfolios. Ask yourselves, are you ready for the reality where the S&P 500, arguably since 2020, no longer has a clear and obvious advantage over precious metals? Because 2% in gold and silver, in my opinion, simply isn't going to cut it moving forward. And I want you all to be aware of that. This brings us to a critical question that many of you are thinking about. A viewer, Gun Bjorn, asked if I think it's possible that governments could make silver ownership illegal due to the increasing scarcity of the metal. He is referring to the prolonged supply deficits that we are seeing for silver, and this is an economic force you need to understand. Let's start with the facts. It is clear that demand for silver is outpacing the rate at which it is being mined out of the ground. This isn't a short-term problem. A lack of investment in new mines over the past 15 years or so means this problem isn't going away anytime soon. This supply crunch is happening at the exact same time that industrial demand for silver is exploding. Think solar panels, electric vehicles, and all electronics. This is colliding with a growing investor interest in physical silver due to higher metals prices. You have a classic economic squeeze. shrinking supply and growing demand from two different sectors, industry and investment. Because of that, serious news outlets are starting to report on a fact we've discussed here for years. That fact is that silver could start to catch the eye of national governments, not just as money, but as a strategic resource. It could be classified much like some rare earth minerals have been. If that happens, it would drive the price up much higher, and in a much more sustainable way than we've seen in past speculative spikes. Now, you may ask, is there a precedent for this? The answer is yes, and here is the connection that most are missing. A great example of this is how the Pentagon, that is the U.S. Department of Defense, recently took a 60% stake in the mining company MP Materials. Why? Because MP Materials mines rare earth metals used in magnets that are critical in advanced defense systems, from drones to missile guidance. This is the new model. The government didn't need to confiscate the resource. It just bought the company that mines the resource. Now, what does this blueprint mean for silver? If we see silver officially classified as critical, and we see the U.S. government or another large government start to take a direct interest in it, the game changes instantly. For example, if the Pentagon decides to buy a silver miner to secure its own supply chain, we would likely see a major spike, not just in the stock price of the company they buy, like we've seen with MP Materials. We would see a spike across the entire board, for all silver miners and, of course, for the price of physical silver itself. I think what we've seen with MP Materials is the model we're going to see moving forward, at least for the foreseeable future. This means that instead of confiscating metals, which is a logistical and political nightmare, we will see a situation where a government, possibly the U.S. government, becomes a major buyer. They will become a competitor to you in the marketplace. This action drives price up, not only on the physical side, but also from the supply side by purchasing the miners directly. That said, this doesn't mean there isn't any risk to how we buy and sell precious metals today, because the real risk precious metal stackers may face in the future is not what you think. It's not confiscation. It's a possible ban, not on owning precious metals, but on buying them, or at least buying any new supply. And it's news coming out of the European Union that has gotten me really thinking about this. Their central bank has said that gold poses a risk to financial stability. Let's unpack what that statement really means. This is the time. And it's not just a guess. Gold recently passed the euro to become the world's second largest global reserve asset. This isn't a headline from some gold bug website. This comes from the European Central Bank itself in its own report. What they're really afraid of, and what the United States could be worried about too, is not a sudden spike in the price of gold disrupting trading, like they claim. Their real fear is a continued migration. A migration out of fiat currencies like the dollar and the euro, and into gold, and to a lesser extent, silver as well. This migration causes a drop in demand for their currencies and for their debt. It makes it harder for them to artificially prop up their economies. And we've seen clear clues to this. Ideas are coming out of the European Commission, the EU's executive branch, suggesting that special bank accounts be set up. Accounts that would allow the European Union to tap into the 10 trillion, with a T, 10 trillion, of what they like to call unused savings. They want to tap your savings so they can fund military and social programs without having to convince savers to lend them their money by buying government bonds. This plan would basically bypass that entire market. But here is the economic connection. Every €1 that goes into precious metals is €1 they cannot access. This poses a direct threat to their plan. It gives them a powerful incentive not to confiscate your precious metals. As I've already said, that's a nightmare. But to ban the ability to purchase them, specifically newly minted bullion products. This scenario would mean that whatever the private supply of gold and silver is in the market today will trade amongst the population, but no new supply would be added. Now, although I am entertaining the idea, I don't think a ban on buying precious metals is the model they will go for. Not in Europe and not in the United States. Because if push comes to shove and these governments really need gold and silver and have difficulty procuring it, what I think will happen instead is what we are already seeing in the European Union for silver. They won't ban it. They will tax it. A sales tax, or value-added tax, will be added to the price of metals. This makes them less affordable and less viable as a savings mechanism for regular people. And although I have said that metals confiscation is a nonsense idea multiple times on this channel in the past, not only do I think this taxation model is a possibility, I think it's something people should prepare for. You prepare by continuing to stack on a schedule now, before such taxes come into place. Because if this increasing demand motivates governments to attack private physical investment demand for gold and silver, it just means things for their fiat currencies aren't trending in the right direction. And we know that's the case already. Because of that, you'll still want to own gold and silver. The only thing is, as many Europeans who are already paying high value-added taxes on silver today know very well, it's that it will simply become more expensive to do so. And that's why I think it's better to get ahead of that. Forget about the tales of confiscation that fearmongers want you to believe in order to support whatever marketing they're involved with. We don't need fear as a motivating factor to stack gold and silver. In fact, I do it out of confidence. Confidence that the trend we've seen established over the last 25 years, which has resulted in higher metals prices and currency debasement around the world, is going to continue. And I think anyone seriously preparing for their financial future needs to do the same. Because as I've presented in this video, the financial game is being stacked against the little guy. It's all thanks to lower interest rates, falling dividend yields, and higher rates of inflation, which are all associated with the debasement of fiat currency. And it's hard asset ownership. Owning gold, silver, land, productive dividend-paying stocks, maybe some income-generating real estate. That is really going to determine where you end up, as the disparity in wealth between rich and poor continues to grow. And that's why I urge you all to open the books, make sure you're not too deep in the banker's game, and get yourself some hard assets before it becomes more difficult to do so. Mr. Gunbjorn, I hope that answers your question adequately.